Do you think the market moves in pure chaos? The truth is, there are rules behind that chaos. In our last lessons, we talked about what trading is and why analysis matters. But to really feel the market, you need a solid foundation. So let's break down the core concept every trader must know. Think of it as the ABC of trading, the basics you need to memorize if you want to read charts and make trades with confidence. Alright, let's go step by step. Imagine the market is a living organism that's constantly breathing. Every inhale and exhale is a wave. And just like in nature, the market has waves of different sizes. Small waves of buying and selling appears during each trading session. These are created by day traders who make money from short-term moves within a single day. They are the ones constantly tugging the price up and down. And by watching these moves, we can tell whether the market is getting stronger or weaker. In trading, a strong market is called bullish, while a weak market is called bearish. But all the small waves are just part of a larger ones that can last several days. And those, in turn, are part of even bigger waves stretching across weeks. In simple terms, the market is nothing but waves. And together, these market waves form cycles. Richard Wyckoff, an American investor and technical analyst, was one of the first to notice that market waves are not random. Instead, they form recognizable cycles. He divided them into 4 phases: accumulations, markup, impulse, distribution, and markdown decline. The cycle begins with accumulations. At this stage, the market is full of uncertainty. Price moves within a narrow range and no one knows what will happen next. But quietly, demand for the asset starts to build, almost as if someone is secretly buying it up in preparation for something bigger. When demand finally outweighs supply, the impulse phase begins. Price breaks out of the narrow range and starts climbing. New buyers rush in, attracted by the growth. Everyone wants to profit and demand continues to fuel the rise. Once price reaches its peak, distribution takes place. Demand weakens and sellers begin locking in profits. Price stops rising and starts moving sideways within a wider range. When supply overtakes demand, the decline begins. Price starts falling, panic spreads, and traders rush to sell their assets to save what they can. The price keeps dropping until eventually the cycle resets. In short, cycles and waves are what we call trends. If you can learn to recognize which market phase the market is in, you will be able to make more informed and balanced decisions. It's not a magic wand that guarantees instant profit, but it's a powerful tool that can significantly improve your trading results. After every strong move up or down comes a period of consolidation, when buyers and sellers reach temporary balance and price gets stuck in a certain range. This range is known as the balance zone. In the balance zone, the market is in equilibrium. Buyers and sellers are roughly equal in strength and price can decide which way to move. It's like a tug of war where neither side is able to win. The balance zone has 2 boundaries. The upper boundary is called resistance and the lower boundary is called support. When price approaches resistance, sellers usually gain strength and push it back down. When price approaches support, buyers gain strength and push it back up. But sooner or later, this equilibrium breaks and price breaks out of the balance zone. This can happen in 2 ways. Buyers become stronger and price breaks through resistance. Sellers take control and price breaks through support. A breakout from the balance zone is a powerful signal that often marks the start of a new trend. Traders use balance zone in different ways. For example, buy near the lower boundary support and sell nearby the upper boundary resistance. Or wait for a breakout and trade in the direction of the move. In essence, the balance zone is what we also call a flat market, consolidation, or range. And that brings us to the end of this lesson. But this is only the beginning. There is much more ahead. The knowledge you've just gained is the key to understanding what's happening in the market and where to move next.